Welcome back guys to another video. Today Ernie's going to be talking about different strategies that you can use on zero DTE. If you're interested in becoming a pro trader, as always, check out the link in the description for a 4-week trial. Enjoy.
Now, the butterfly is an interesting trade. Butterfly is a trade that a lot of you have probably used for earnings plays. So you know that there's going to be potentially a big move coming up because of earnings coming out, your favorite stock du jour. But you don't know which way it's going to go. But you think it might go positively. It might go negative. But you don't know how far. And you want to put on a trade that's going to give you a really good risk to reward. So a typical earnings play might be to take that butterfly and put it way out of the money, make it nice and wide so it doesn't cost you very much. And that would be a typical asymmetric trade. And if it does go up there, you make a lot of money. You could also put on a straddle. Straddle might be another way to go. If you think there's going to be a big move, but you don't know if it's going to go up or down, you can put on a straddle. And so if you have a very large move up or very large move down, then you can make some money. Unlimited reward and defined risk. Although the risk can be quite big if the volatility is high enough. So those are some ideas. The iron condor is probably the most popular for zero DTE. So the ones that I've mentioned so far are things like a credit spread or a vertical. And I'm going to draw the risk graph and what it might look like. So a vertical might look like this. A butterfly might look like this. Straddle might look like this. Then there's a strangle that might look like this. There's the iron condor that looks like this. There's the calendar spread that kind of look this. So what we're missing out of here is where's the zero line. Now typically on a vertical, zero line would be right here. Now on a butterfly, the zero line could be a number of different places. Zero line on a butterfly could be one of two places. So it could be way up here if it's an at the money butterfly, or it could be way down here. The difference is in the amount of risk. A lot of risk here, tiny little risk there. Straddle will look something like this. Strangle will look like this. Iron condor will look something like this. This would be your calendar spread, something like that. Now, where I'm putting these zero lines is really important because you can see here with, for instance, the vertical. A lot of people are putting on verticals where they're right at the money, so they typically will have a 1-to-1 risk to reward ratio. At the money butterfly, it'll be really skewed, but it'll be something like maybe 5-to-1. Now, there's unlimited potential profit on straddle right here. However, this risk can be pretty big. And if you start here in the middle, this width here is pretty important. Typically on a straddle, that's considered a 1 standard deviation move where it intersects the zero lines. And this risk can be quite big. So for instance, in a simple daily straddle on the SPX, that risk could be anywhere from say $2,000 to $5,000. That's quite a bit. You do not have a strong enough move where you escape the break-evens. The strangle is kind of like the opposite of that. I mean, there are two different ways that you can do the strangle. This is a short strangle, and this is a long straddle. You can also have a short straddle as well. It looks a lot like the strangle, only it comes up at a point. The problem is that the short straddle and the short strangle both have unlimited risk. So they have unlimited risk. So if you go too far this way or that way, you could lose a lot of money. So you have to stay within these break-evens, which is typically 1 standard deviation.
Thanks for watching guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.